just hear a quick word on the dynamics we're seeing in this market this year. We've seen it up well over 12%. Today it's back on the up. We haven't actually seen the market dip for more than 2 consecutive trading sessions this year. So it's interesting to see what is going on right now.
Yeah, thank you. I think it's just a carryover of the late, should I say, late rally in the last 4 months of 2012. And essentially that's what, that kind of defines the discussion around this. That momentum, no doubt triggered off by the extensive reforms, particularly the market maker initiative of the NSE, is actually projected to continue into the new year. Keep in mind too, like you rightly said, we've not seen the market dip more than 2% day-to-day trading since the beginning of 2013. And I think that should be expected, bearing in mind that the financial services sector, one of the major, should I say, bellwethers of the market, it's rife with expectations.
Right. Of course, the expectations, if I can just cut in there, is the results particularly from the banks. I think by the end of March, we should see some results coming through. And of course, now there's a lot of positioning ahead of that for dividends. And I want to first of all get your thoughts on whether or not there's a compelling push for banks to pay good dividends in this earnings season. What are your thoughts on that, considering the fact that we're now totally out of a crisis? I think that's the consensus view right now.
Yeah, permit me to look at it from 2 perspectives. You have the from a hard stock savvy investor's perspective, this should be a period of consolidation. I mean, we've just come out of, as you said, a crisis situation. Banks have largely turned the corner on profitability, and a lot of talk has been in the air about consolidating on growth. So to that extent, yes, we would expect banks to be looking from a strategic point of view towards capital gains, capitalizing their profits and things like that. But we also have to look at the other perspective too of, some may not consider it too important, but really it is the retail investors who've taken a battering over the years. And but to the extent that we're looking at increasing investor confidence in the market, particularly the market players, that could go a long way in influencing the way banks view that dividend payout decision. Now, I think to a large extent, yes, there will be that push, maybe not compelling in that sense, but that push to bolster confidence, and that could influence, increased payouts. But I kind of expect to see a measured approach to it from the banking industry.
Do you think there's any reason why banks need to hold cash, though? Is there a reason for them to hold back a little bit? Or do you think that, as the consensus is, the worst is over for the banking sector and it's probably about time they begin to reward investors?
I don't think there's a compelling reason to hold back cash, per se. But like I said, I mean, my thoughts on that would just be that these 2 perspectives would define those decisions. And I think banks would largely go in the line of a measured approach to it. Increased payout, definitely, relative to the last 2 years, but not the kind of scenarios we saw before the crisis, where we're talking of regions about 50% and things like that. I don't really expect to see much of that in this early stages of post-recovery, banking industry performance. Right.
While I was running through the top stories, I did mention that IFC bond. Now we're hearing that it should be issued somewhere between 10 and 11%, and it's slightly lower than similar FGM bond, at least FGM bonds of similar tenor. At least that is the logic behind that pricing. Are you surprised at the rates that the IFC is issuing this bond, and in your view, what's going to be the uptake for this bond?
My thinking on first glance is that it should be expected considering the rating of the IFC bonds. But again, my take on that, it just accentuates increasing global investor confidence in the market. And I think that's a major benefit that should come to us, that should come to the market on account of this. Now, the bonds, the pricing of the bonds will, I mean, if I were to take the argument a little further, increasing investor confidence, and logically you would expect increasing inflows, yes, that should sustain the pressure, or the downward pressure on the bond prices. But by and large, I think the biggest advantage to us is the increased investor confidence coming on the back of the listing by JP Morgan and on the Barclays listing for emerging markets, which we've also benefited from as a country.
Now, I think an interesting dynamic here, especially for savvy investors looking to invest in Nigeria, is for those who are happy with the risk that the IFC provides, they may want to invest in that bond and take a decent 10% or so. Of course, if they are investing elsewhere or across the world, it would be much less, especially in the developed markets. So your take on that point, do you think even foreign investors will be looking to buy this bond?
In my opinion, yes. Because even if you look at it on a broad basis, it's still relatively high, low as it may be compared with the highs we've seen on Nigerian bonds in the recent past. It's still comparatively higher than probably Brazil and the countries that could come close in terms of their current yield. So I still think that it's going to be a win-win situation, so to say, for our own market, because much as the rates are lower comparatively, they're still relatively higher than similar frontier and emerging markets around the world.